Hey everyone, welcome to the Financial Nexus. I'm your host, and if you've been following global markets lately, you know something fundamental has shifted in the past few weeks. What we're witnessing isn't just another geopolitical flare-up or temporary market volatility. This is the early stage of what could become the most significant restructuring of global financial architecture since the Bretton Woods collapse. The numbers coming out of energy markets right now tell a story that most mainstream analysts are either missing or deliberately avoiding. Brent crude spiked to $119 per barrel on March 19th, but that headline figure only captures the surface of what's actually happening. The real story lies in what this price movement represents about the fundamental structure of global energy supply and the financial system that depends on it. The closure of the Strait of Hormuz has effectively removed 20% of global oil and 21% of liquefied natural gas from international markets. But here's what the financial media isn't telling you. This isn't just about energy. The same shipping routes that carry oil and gas also transport 20% of global fertilizer supplies. The cascade effects we're seeing in agricultural futures, food security projections, and emerging market currencies all trace back to this single choke point. When the International Energy Agency's executive director Fatih Birol describes this as the largest supply disruption in the history of the global oil market, he's not using hyperbole. The mathematics of energy supply and demand have fundamentally shifted, and the financial implications extend far beyond what most market participants understand. Goldman Sachs has revised their oil price forecasts for the remainder of 2026. Projecting Brent crude will average $85 per barrel. But even Goldman's sophisticated models may be underestimating the structural nature of this crisis. What we're seeing isn't a temporary shock that will resolve through normal market mechanisms. This is a permanent reconfiguration of energy geopolitics that will force every major economy to recalculate their strategic assumptions. The financial system's response reveals just how unprepared institutions were for this scenario. Money market fund assets reached a new record of $7.86 trillion in the week ending March 18th, representing a $38 billion increase in just 7 days. This isn't normal profit-taking or portfolio rebalancing. This is institutional panic disguised as prudent risk management. When professional money managers move nearly $40 billion into cash equivalents in a single week, they're not responding to temporary volatility. They're positioning for systemic breakdown. The velocity of this capital flight suggests that major institutions have stress-tested scenarios that haven't been disclosed to retail investors or even regulatory authorities. The Federal Reserve's response has been telling in what it doesn't say as much as what it does. Interest rate futures now show a 60% probability that the Fed will keep rates unchanged for the remainder of 2026. Up from just 5% 1 month ago. The market has essentially priced out any possibility of monetary easing, even as economic indicators suggest the economy is slowing. This creates a policy trap that central bankers have never faced before. Traditional recession-fighting tools assume that energy costs represent a manageable input to economic activity. When energy becomes structurally scarce and geopolitically weaponized, monetary policy becomes ineffective or even counterproductive. Lowering interest rates can't conjure oil that doesn't exist or navigate shipping routes that are closed by military conflict. The European Central Bank has been more explicit about their constraints, stating that inflation projections for 2026 have been revised upward, specifically due to higher energy prices from the Middle East conflict. European economies, dependent on energy imports, face a particularly acute version of this challenge. They cannot substitute away from Middle Eastern energy sources quickly enough to avoid severe economic disruption. What makes this crisis different from previous oil shocks is the intersection with existing financial vulnerabilities that have been building for years. Corporate debt levels in Europe have reached a 4-year high, with 13.5% of companies now classified as under financial stress. The energy shock is acting as what analysts call a distress multiplier, hitting leveraged manufacturers and retailers hardest as both costs and debt burdens rise simultaneously. The timing couldn't be worse for over-leveraged sectors of the economy. Private credit markets, which have grown to roughly $1.7 trillion globally, are already experiencing redemption pressures as investors question returns in a higher rate environment. Energy price volatility adds another layer of uncertainty that these illiquid investment vehicles are poorly equipped to handle. But the real systemic risk lies in the derivatives markets. According to the Bank for International Settlements, approximately $2.4 trillion in energy-related derivatives are outstanding globally. Even small movements in underlying energy prices can trigger massive margin calls and forced liquidations in these leveraged positions. When energy prices move as dramatically as they have in recent weeks, the mathematical stress on these positions becomes extreme. The geopolitical implications extend beyond immediate economic effects into questions of monetary system stability. Countries that control energy resources are gaining leverage that they haven't possessed since the 1970s, but the global financial architecture is far more complex and fragile now than it was 50 years ago. Digital payment systems, interconnected derivatives markets, and just-in-time supply chains create vulnerabilities that didn't exist during previous energy crises. China's response has been particularly strategic and revealing. Rather than participating in the panicked buying that has driven oil prices higher, Chinese state entities have been quietly accumulating energy futures contracts at various price points, essentially building a strategic price hedge using financial markets rather than physical storage. This approach suggests Chinese policymakers understood the structural nature of this crisis before Western institutions recognized it. The implications for the US dollar's role as the global reserve currency are becoming apparent in foreign exchange markets. The dollar index fell 1.7% in a single day, the largest decline since March 2020. When energy becomes scarce and geopolitically controlled, countries begin questioning whether holding dollars provides the same security it once did. Energy exporting nations gain the ability to demand alternative payment mechanisms or preferred trading relationships. This isn't speculation about future possibilities. These dynamics are already reshaping international trade relationships and financial flows. Countries with domestic energy resources or secure supply relationships are attracting capital and investment at the expense of energy-dependent economies. The financial architecture that assumed abundant, cheap energy is being stress-tested in real time. The Federal Reserve faces an impossible choice between fighting inflation through higher interest rates, which would accelerate economic contraction, or accepting persistent inflation to avoid triggering a deflationary collapse. Traditional central banking models assume these trade-offs can be managed through gradual policy adjustments. Energy supply shocks eliminate the luxury of gradual adjustments. What we're witnessing is the early stage of a forced reorganization of global economic relationships around energy security rather than financial optimization. Countries, companies, and investment strategies that recognize this transition early will adapt successfully. Those that continue operating under assumptions of abundant, cheap energy will face increasingly severe challenges. The next phase of this crisis will likely involve more direct government intervention in energy markets, strategic partnerships between consuming and producing nations, and a gradual decoupling of economic relationships that no longer provide energy security. The financial markets are beginning to price these possibilities, but the full implications haven't been absorbed yet. Thanks for staying with me through this analysis. The intersection of energy geopolitics and financial system stability is evolving rapidly, and understanding these connections is crucial for navigating what's coming next. If this breakdown helped clarify the situation, make sure to hit that like button and subscribe for more deep dives into the forces reshaping our economic reality. Until next time, stay informed and stay ahead of the curve.